Mean reversion strategies are used by funds like the Medallion Fund, the most successful trading fund in history. So before we even get into the mechanics, just know this isn't some retail trader hobby theory. This is how the sharpest money in the world has operated for decades. The question is whether you understand it well enough to actually use it. Most traders don't. And that's not me being harsh, as it's just the reality. The majority of people in the market are momentum chasers. They see a big green candle and they buy. They see red and they panic. They're always reacting, always one step behind, always buying high and selling low, while convincing themselves they're doing the right thing. The market is essentially a machine that transfers money from impatient people to patient ones. Mean reversion is how the patient ones think. Here's the core idea. Price does not trend forever. It stretches away from its average, sometimes aggressively, sometimes violently, and then it comes back. It always comes back. That's not a theory or an opinion, that's just the empirical reality of how price behaves across every liquid market that has ever existed. The mean acts like a magnet, and the further price moves away from it, the stronger that magnetic pull becomes. Think of it like a rubber band. You can pull it further, but there is a point where the tension becomes unsustainable, and it snaps back. The traders who profit from mean reversion are the ones waiting patiently on the other end of that rubber band. Calm, positioned, ready. Now here's where most explanations stop. Right at the concept level. And then they leave you alone with a live chart, staring at candles, wondering what you're actually supposed to do. So let's go deeper. A mean reversion setup begins with an extended move. Price has been running hard and fast in one direction. If you pull up your RSI, it's deep in overbought or oversold territory. The candles are getting smaller, the momentum is visibly fading. Volume is drying up. Price is stretched far from the moving average, sitting in a place it statistically doesn't stay for long. This is the conditions phase. You're not trading yet. You're watching. What you're waiting for is exhaustion, not a prediction, evidence. A strong rejection wick where buyers or sellers tried to push further and got hammered back. A sharp reversal candle that closes with conviction in the opposite direction. A break in the short-term structure that tells you the people who are driving the move have run out of steam. That's your entry trigger. That's the moment the rubber band starts to snap back. Your stop goes just beyond the recent extreme. Above the high if you're shorting. Below the low if you're going long. Before you enter the trade, you know exactly what you're risking. That number is fixed. And everything else, all the potential upside, is just price doing what it always does. Returning to value. The target is the mean, the area price left in a hurry. And because mean reversion moves tend to be fast and sharp once they start, the risk reward on these trades is often 3 to 1, 4 to 1, sometimes significantly better. You're not grinding for small edges, you're waiting for price to be genuinely stretched, genuinely exhausted, and then catching the full reversal. This is why mean reversion works when momentum trading doesn't. Momentum traders are buying into strength, which means buying expensive, with a crowded trade, with everyone already positioned in the same direction. Mean reversion traders are doing the opposite, buying into weakness, selling into strength, getting in when it's uncomfortable because that discomfort is exactly where the edge lives. Now let's talk about the hardest part, because it's not the analysis, it's not finding the setup. The hardest part is the waiting, sitting on your hands while price continues to push against you, knowing it's extended, knowing the data says it should turn, and not flinching, not jumping in too early, not abandoning the trade when it moves 2 pips past your entry before reversing. Discipline is the entire game. The strategy is almost secondary. The traders who master mean reversion aren't special. They're not smarter. They've just built the patience to wait for genuinely high-quality setups and the conviction to hold them when it gets uncomfortable. That's a skill you can develop. It just takes time, repetition, and ideally, seeing enough real trades play out that the pattern becomes second nature. One way to accelerate that process is surrounding yourself with traders who are already doing this at a high level. Watching real entries happen in real time, seeing how extended is actually extended enough. Understanding what exhaustion actually looks like, not in a textbook, but on a live chart, in a live market. If you want to see what this looks like in practice, come find us, mmsignals.com.